Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Elconin, along with Brianna Valesky, and we have Robert Green on the line. He's a CPA and founder of Green NFH LLC. That is a tax and accounting firm catering to investors, traders, and investment management business. Robert is seen as the leading authority on trader tax. Robert, how you doing on this Tuesday morning?
Very good. Thank you.
All right, so let's get right to it. It's coming down to the end of the year, a month left in the year, wrapping things up for 2014. Hopefully, our traders are sitting on a lot of profits and perhaps some losses as well. How should traders, start to position themselves here? I know each case is an individual basis, but on the whole, how should they be approaching the end of the year to get ready to pay Uncle Sam?
Well, first, see which camp you're in. Either in the high income camp, where you want to avoid the Obama era tax hikes, including the net investment tax when you make over 250,000 adjusted gross income married or 200,000 single. In that case, you want to defer income and accelerate expenses. So if you're holding on to some winning positions, perhaps let them run through year end if they're securities. Conversely, if you're in the low income camp, perhaps you had an off year in the markets or you left a job and you're in a very low tax bracket. You may even have wasted itemized deductions. In that case, accelerate income. You can take a long-term capital gain in the lowest brackets up to 70,000 and change. It's 0% for the tax rate. Plus, you can utilize your otherwise wasted itemized deductions. And one way to soak up those lower tax rates is with a Roth IRA conversion.
And just explain the advantages of the Roth over your traditional IRA.
Well, you always want to contribute to a retirement account and then self-direct and trade that account if you're a trader. A traditional plan gives you a tax deduction. That's great. Most people like that. A Roth contribution is not tax deductible, but it's permanently tax-free. A Roth conversion is a little different. You take your traditional plan, you figure the amount of income you want to convert, and you bust up your plan to the amount you want to convert, and you need to do this before year end. You tell your broker, I want to transfer from my traditional plan to a Roth $100,000. Now, that's like checking out of the restaurant. You're going to get your bill before you finish the meal. You're going to check out, pay your bill. You're going to pay the taxes on the $100,000. And if you're in a very low tax bracket and have wasted itemized deductions, you're going to pay a very low tax bill. Now the money is sitting in a Roth. It can grow tax-free for life. And when you take the money out in retirement, it's tax-free. Now, if the money goes down a lot next year in the markets and you say to yourself, why did I check out of the restaurant? The money dropped in value. No problem. You can recharacterize and reverse the transaction as if it never happened.
Oh, okay. Wow, interesting point there. So let's talk about deductions, and there's what are some of the deductions that traders, should, really take as far as home offices and things like that, and what are the ones that the IRS may frown upon a little bit?
Well, traders have about $15,000 to $25,000 of deductions on average. That's not a lot. The IRS does not get worked up over that. Home office is one of the biggest ones, and it happens to require income. And we accomplish that by transferring some of the business trading gains on other forms like Schedule D over to the sole proprietor Schedule C to unlock that deduction. And you definitely want to take all your expenses, otherwise it doesn't look like a business. So remember, a business trader qualifies for trader tax status, meeting our golden rules. 1,000 total trades a year, trades on 4 days a week, over 4 hours a day. It's for the very trader. If you fall short, you're stuck with investment expense treatment, which is very limited on Schedule A as a miscellaneous itemized deduction in excess of 2% of adjusted gross income, not deductible for the alternative minimum tax, and there's the piece limitation if you're higher income. And there's no home office for investors, no education, no seminars. Whereas for the business trader, they get the education and the seminars. So here's what you do going into year end. If you've been a business trader for this period of the year, and you can claim it after the fact, you don't elect it, then go ahead and accelerate your expenses. Put that computer on your credit card going into year end. Conversely, if you've been an investor this year and you expect to be a business trader starting in January of next year, then perhaps defer some of the expenses to the business period where they give you a lot more bang for the buck.
Okay, let's move away from the trader and the individual business trader, and let's just talk about the wash sale rule and the nuances. Is really no way around it, but let's just discuss that and how that could be advantageous, and what are the restrictions on selling stocks that are at a loss.
Right. All investors who trade securities need to be concerned with wash sale losses. If you take a loss and you happen to buy back that same position 30 days before or after, it's a 60-day window, it's a wash sale. The IRS forces you to defer the loss and to tag it onto the cost basis of that replacement position. All active traders, even casual investors, have wash sales. They're more active in a 60-day window. As you go into year end is when it really counts. Because if you take a loss in December and get back into the position in January, the IRS will make you push that loss to 2015, and that could raise your tax bill for 2014. So get trade log software. Download your trades. There's a potential wash sale loss report, and here's the key. Brokers only report wash sales based on identical positions, the same symbol, and only for that one account. You, the taxpayer, have different rules. It's apples and oranges. You have to report wash sales based on substantially identical positions, which means between stocks and options at different strike prices at different dates. And on all accounts, your account, your spouse's account, your joint account, and here's the real key, and your IRAs. And that's a catastrophic problem to have a wash sale in your taxable account because that goes into your IRA because you never get the benefit in your IRA. Trade log will do those calculations for you. So here's what you do at year end. If you see you have a wash sale condition, don't panic. Get out of the position, especially if the wash sale is hurting you, meaning that it's creating phantom income for you to pay taxes on. If you have a capital loss carryover that's huge, the wash sale may not bother you. But if it's hurting you, get out of the position and don't get back into that same substantially identical position for the 30-day period. So-called break the chain. You can break the chain with an entity on January 1st, too. An entity is a different taxpayer. So that also disconnects the wash sales. That also fixes the IRA problem. So get on top of your wash sales. And here's some gold for you, Joel.
I like gold.
If you like gold, I know that. Turning tax garbage into gold. That's what a good tax advisor does. A big wash sale at this year end. If you have a large capital loss carryover and you're going to be a business trader next year and elect Section 475 mark-to-market accounting, ordinary loss, tax loss insurance, you can turn your year-end wash sale on business positions into a business ordinary loss on January 1st. That's a huge savings for those who can do it. So you can read about that a little bit more on our year-end tax planning blog at greentradertax.com.
Also, I was talking with a buddy of mine too, who had been trading something in the oil services sector, and he had a loss on it, and he was gonna book the loss, but he still wanted to stay into the sector. So what he was gonna do was he was gonna take the tax loss, but he was gonna sell something, but not but buy something that was different, like
Right.
yeah. So that's one other
Yeah, if
way.
it's a different company, it's not substantially identical. Google is not substantially identical to Apple. Only Apple stock and Apple options are substantially identical.
Okay. All right. All right. Just any final tip for our traders and investors here going into year end?
Well, also, the Obamacare open enrollment is open now. Traders and investors have fluctuating income. If you want a shot at those premium tax credits, which are substantial, you need to go through an exchange. If you go off exchange, you can never get a premium tax credit. There's that whole Obamacare thing has really popped up on everyone for this year. It's going to be part of your 2004 tax preparation. We have a very good blog about that as well. And lastly, Joel, a lot of people are talking about the tax extenders. Will they happen before year end? And I have a feeling Congress may pass them for a 1 year extension, which means 2014 only, and start with a clean slate for 2015 to negotiate tax reform.
Okay, Robert Green, CPA and founder of Green NFH LLC, joining us here on Benzinga's pre-market prep. Robert, thanks for joining us, and perhaps we'll get you in here a little bit closer to the actual tax season and see if you have any more tips for us.
That would be great. Thank you, Joel.